This is the last problem of our last chapter for the whole semester. Can you believe it? I know, I can't either. So, this problem asks us to do an entire statement of cash flows. So, it gave us, you should have your selected problems out, right? Gave us a balance sheet this year and last year. Gave me an income statement. We know our formula for operating activities, which we're going to start first. And if we look on the second page, there are some other data. But if I were to read these 4 pieces of other data, please trust me on it. It is not operating activities. So I want to start off the statement of cash flows with operating activities. It is the first type of activities that we start with. And we will come to the last 4 pieces of additional information when we prepare the investing and financing sections of this balance sheet. So here we go. Always, we start off with a heading. And this happens to be Turner Incorporated. So, this also happens to be 2017. So, let's put our heading up. We know it's company name. The second line is what statement this is. This is statement of cash flows. And this is for a period of time. Because if we remember, the only one of our 4 financial statements is actually dated for a very specific day is balance sheet. So the statement of cash flows tells me about the money coming in and out based on our activities. And we've discussed the 3 types of activities already, right? There are 3 investing, there are 3 financing, and then all others are operating. Right? So let's look at our formula for the indirect method of doing our operating activities. And it says, and so I need 2 columns. We know that on our formal 4 financial statements, first column out, the furthest column out, always represents totals. And this represents the inside column, subtotals. So what I'm going to do is I'm going to do all my operating activities, and I'm going to subtotal them in the subtotals column. And when we get to total operating activities, I'm going to move it over into the totals column. So I'm going to use and utilize the subtotals column. So first things first, operating activities, I need a heading. And we know that heading is cash flows from operating activities. And then we are going to follow this formula. Right? So we have spoken before, and we have said always, that net income, depreciation, amortization, and losses and gains on the sale of property, plant, and equipment, and long-term investments, these come off the income statement. So I need to look for them on the income statement. And notice I gave us an income statement. And looky, on this income statement, the first thing I see is that net income is $137,000. So let's start off with that. $137,000. First number in the column gets a dollar sign. Then, if there's any depreciation, because this really is just a checklist, right? If there's any depreciation, I want to add it back. If there's any depreciation, I would see it on the income statement. And look, there it is. So then I add back my depreciation. Now, in a little bit, because I need more space, certainly, to do this statement of cash flows, I'm going to have to erase, before we get to investing activities, this side of the board. But I need us to remember the depreciation. And of course, hopefully you also have it right in front of you, right, because you're working your selected problems with me. Our depreciation expense on the income statement was $50,000. So here it is. The next says, amortization expense. If you have it, add it back. Well, I'm looking on the income statement. This doesn't say amortization expense. This doesn't say amortization expense. It doesn't nowhere. This is a checklist. If I don't have it, I just keep moving. We don't have amortization expense, so I'll let it go. Then it says, well, if you have any gains or losses on the sale of property, plant, and equipment, or long-term investments, you need to add or subtract them back depending on what you have. So I look and I see this loss on the sale of a plant asset. And if I have a loss, I want to add it back. So I'm going to add back loss on sale of plant asset. Looks like $9,000. And it doesn't appear I have any gains, so I don't see them. So at that point, I don't need the income statement anymore. Right? But I do need space in a moment. But now it says you need to go to your balance sheet and look at your current assets and your current liabilities with the exception of cash and determine if there's a change in them. Now, I was not nice. On this balance sheet, I didn't classify it for us. So we need to classify it because I only need current assets and current liabilities here. So cash, we know, is a quintessential current asset. Accounts receivable, inventory, and prepaid expenses are. Notice that your slide problem doesn't have LT in front of investment. That's a typo on my part. Please put LT in front of that. That is a long-term investment. But certainly long-term investments, especially when they're classified as such, and I see plant assets, and plant assets last more than 1 year. And accumulated depreciation is a contra asset that's associated with my long-term asset of plant assets. None of those are current. So be very careful. I want only the changes in my current assets, except for cash, and then my current liabilities. So accounts payable and accrued expenses payable, those are current. But bonds payable, we just finished chapter 12 2 chapters ago. Bonds payable are a long-term liability, right? And then common stock and retained earnings is shareholder equity. So these are my only current liabilities. And these are the only current assets that I want to look at because the rule says don't do cash. Okay. So let's get our changes. So when I see that my accounts receivable last year was 41 and this year it's 57, I see the change is 16,000. Did it go up or down this year? And by this year I'm talking about 2017. To go from 41 to 57, it went up. My inventory decreased by 3,000 and my prepaid expenses increased by 3,000. As far as my liabilities, accounts payable went from 51 to 44, so we've got a $7,000 decrease. And then my accrued expenses payable increased 6,000. So I want to evaluate, right, these increases and decreases in current assets and current liabilities and place them as the last part of this formula, right, for the indirect method of operating activities. So, my accounts receivable, a current asset, increased. When I have a current asset that's changed during the year and it's changed by increasing, I subtract that increase. So I would like to subtract the increase in my accounts receivable, which was 16,000. My inventory of current asset decreased. When I have a current asset that decreases, I add the change. And then we've got our prepaid expenses, things like prepaid insurance and supplies, right? They have, during this period, also increased. So when I have an increasing current asset change, then I subtract. $3,000. And now it's time to go and evaluate my current liabilities. I have accounts payable, it decreased 7,000. So when I have a current liability that decreased, I subtract out the change. Notice that that runs opposite to what we did with current assets. Because when a current asset decreases, I added it, but not liabilities. Liabilities run opposite. And the last current liability is this accrued expenses payable, 6,000 increase. When I have a current liability that increases, I add that change. And once I've gone through this checklist, I've evaluated everything I need for operating activities using the indirect method. So let's go ahead and combine these. So I'm going to take the 137, then I'm going to take 50, then I'm going to take 9, I'm going to subtract out 16, add 3, minus 3, subtract 7, add 6, and I come up with 179,000 positive. Right? In essence, my inflows, my positive numbers are larger than my negative numbers. So this gives me net cash inflows from operating activities. Typically, we'd have investing activities go further, and then financing. But of course, I'm going to run out of 4. So I still need this balance sheet. I no longer need my income statement, and I no longer need the formula for operating activities. So I'm going to erase those. But I need space for a lot of T accounts as well. So even though you have this written down, I need to erase operating activities because I'm going to do my investing activities here, and I'm going to do the work that is involved with them and putting up all my T accounts over here. So we're going to take a break. When we come back, my board is going to be empty here and here, but you still will have this operating activity. So I'll come cut your fingers off. Okay. So I went and condensed our operating activities, and now it's time to do our investing activities. Hopefully we remember there are only 3 activities that are investing. So we've written them down. Remember, the first one is if I buy or sell property, plant, and equipment for cash. The other is if I buy or sell long-term investments for cash. And the last is if I loan someone money long-term and they pay me back the principal. Because if we remember, the interest is an operating activity. So typically, when I loan someone long-term money, we put that in notes receivable. And as I look at our balance sheet, we don't have any notes receivable. So I don't think this is going to be anything that we're concerned with right now. At least not in this particular statement of cash flows. So overall, these 3 things, buying and selling long-term investments in property, plant, and equipment for cash, and loaning somebody money long-term, are usually seen, these activities, in the balance sheet in my long-term assets, right? In fact, this is where investing activities happen. So I want to look at the long-term section of my balance sheet and see if I can account for every change in these activities. Not only that, there was 4 pieces of additional information on the second page, if you remember. The 2 that are affecting investing activities are the first one that says new plant assets were purchased for $90,000 cash, and the second one says that old plant assets costing $30,000 were sold for $2,000. And again, my pen is getting funny, so let's see if we can find a better pen. Let's try green. So these are the 2 things that affect my investing activities, at least on the additional information. So let's look at the differences in these accounts, right? I want to know the change. So in long-term investments, I went from 130 to 162, which is $32,000 increase. In the additional information, they don't tell me about buying any or selling any. And if we remember, we're using the historical cost principle. So the increase here is not because of market value increase. So at some point I have to make the assumption that I was not given a piece of information that I need. So the only thing I can assume is that I purchased some, and not being told differently, I'm going to assume we purchased them with cash. This is one of my investing activities. So let's put up a heading, right, for investing activities. Cash flows from investing activities. And I'm going to put down that we purchased or bought long-term investments. And I'm going to assume it was in the amount of $32,000, which, by the way, is money that I spent. That is outgoing money. Then I want to look at my plant assets. They started out at $520, they went to $580. Let's see if I can account for this $60,000 increase. Well, along with the information that I have. So let's look at plant assets. Originally, right, they were $520. Now they are $580. And we were told that a new plant asset was purchased for $90,000. First of all, when I buy plant assets, we put it in here, right? And that was $90,000 going in. Wow. So I increased my plant asset account. But you know and I know that 520 plus 90 is not equal to 580, right? But the second piece of information will give me a little more insight. It says that I took an old plant asset costing $30,000 and I sold it for $2,000. So when I took it out, since we keep historical cost principal in the plant asset account, when I sold that asset, I took out all $30,000 because that's how much of that was in here. And when I do that, then I can account for this balance. So be careful, I come in here and now I'm going to sell these plant assets because that also, right, buy or sell property, plant, and equipment for cash. But be careful, this is the statement of cash flows. It's talking about cash in and cash out. So I took an asset that originally costed me $30,000 and I sold it for $2,000. Be careful to only put $2,000 in here because that's the only cash that I got. Right? $30,000 makes this account work, right? And then it means I can account for this change, right? But it doesn't mean that I put the 30 here. I'm just trying to account for the change. And then I want to look at accumulated depreciation. So be careful, follow me here for a minute. Accordingly, at the beginning of the year, accumulated depreciation was $180,000. And at the end of the year, $211,000. We know at the end of the year, when we do an adjusting entry, I debit depreciation expense and I credit accumulated depreciation for my year-end depreciation. And I ask you, how much was my year-end depreciation? What entry did I make this year? And I know you're tempted to say, $31,000, because that's the amount that'll make that T account work. And I beg to differ with you. If you go look at the income statement, the one that I don't have on the board anymore, but that I told you to remember, it clearly told us depreciation expense was $50,000. So at some point, this entry was made at year end for $50,000. And when I place that $50,000 in here, I know that 180 plus 50 does not equal 211. And then I have a problem because I need to account for every change in this account. So the only way mathematically that this could work is that at some point I must have had a debit of $19,000 because that is the only way that I can have this balance, this depreciation, and this balance. So I ask you, when would I normally debit accumulated depreciation? And the only time that we would ever debit depreciation is if I sold an asset. Well, if we remember, we were told we sold an asset that cost $30,000 for $2,000. So we got to do some more math. And I know this is like my statement of cash flow, but I need this board, so I'm going to do it right here. Do we remember Chapter 9, selling a plant asset? The gain or the loss on the plant asset was equal to the difference between what I sold it for and book value. So I ask you, what is the formula for book value? No, you can't tell me you already forgot. Not allowed. Book value, if we remember, is the cost of the asset minus its accumulated depreciation. This equals book value. The asset I sold was $30,000. The accumulated depreciation I'm thinking that belongs to this asset, the one asset I sold, $19,000. So it appears, if I'm correct, that the book value of the asset I sold was $11,000. And if you remember, I sold it for $2,000. So if I have something that is on my books for $11,000 and I sell it for $2,000, did I have a gain or a loss on that sale? And you better tell me we have a loss. All right. And how much was the loss? $9,000. It's beginning to ring a bell. Go back and look at your income statement. I know, it had been on the board. I erased it. You go back and look at our income statement. Did we have a loss on the sale of plant assets, $9,000 on that? We did. And did I account for that loss up here in my operating activities? Yes, I did. So it is my contention, right, that I've accounted for this change, $32,000 here. I've accounted for the $60,000 in the fact that I bought 90, and I put the 90 here. I sold 30, but I only got 2 for that of which I sold. It doesn't appear that we loaned anybody any long-term money, and I can account for the difference here in my accumulated depreciation. 50,000 of it is in operating activities, right, up here, operating activities, right? And then the rest I've accounted for in the 9,000 and then the 2,000 here. So it has been completely accounted for. So in this case, I would say that I've accounted for all the differences in my long-term assets. Okay? Here is buying and selling property, plant, and equipment for cash and selling it. Here is buying long-term investments. We don't have any notes receivable, so I'm saying that there is none. And here we go. Do I have more money in or out when it comes to investing? And I have more money out. So this will be net cash outflows. From investing activities. Right. So it looks like $120,000 going out for these 3 activities that are considered investing. We only have 3 financing activities. So we're going to pause this for just a moment, and when I turn this right back on, all my board over here is going to be erased, and we're going to talk about financing activities. So let's do our financing activities. We know that there are only 3 financing activities. If I issue my stock for cash, or if I buy my shares off the open market for cash, what do we call our shares that we buy off of the open market? I know you're thinking treasury stock. You're right. So if I have any treasury stock transactions, if I pay a cash dividend, or if I borrow long-term money or pay back the principal. Typically, when I loan long-term money, we call that notes receivable. But when I borrow long-term money, that's usually bonds payable and or long-term notes payable. So what we're going to find out is that financing activities, for the most part, affect the long-term liability section of the balance sheet and shareholder equity. So let's go ahead and look at the differences. So it appears that my bonds payable decreased $40,000. My common stock apparently has increased $25,000. And then my my retained earnings has gone from 170 to 267. So let's look at retained earnings first. Do you agree that beginning retained earnings plus net income minus dividends equals ending retained earnings? And they're telling us that my beginning retained earnings was 170. I know from my operating activities, right, and our income statement that I've erased, that net income is $137,000. And it's clearly telling us right now, here's this additional information. Bonds matured and were paid off at face value, and we paid a $40,000 cash dividend. So without knowing, even though I can look and see the balance sheet, right, without knowing, I've already, when we get to the statement of cash flows, I've already prepared the statement of retained earnings. So I already know this number, and it happens to be 267. And it's from the statement of retained earnings that I use this retained earnings in my balance sheet. So I know the difference between the 170 and the 267 is accounted by two different things. One is this net income, which we see up here in operating activities. Right, we've accounted for it. And the other is dividends, right? It's paying this cash dividend. So when I pay a dividend, this is one of my financing activities, and that's money going out. So that takes care of this. And it also takes care of the difference here. I've accounted for it. So let's look at this bonds payable decrease. It tells us that bonds matured in the additional information and were paid off. So this is long-term debt. When I pay off the principal, remember when we pay off matured bonds, we always pay face value, right? And that's the principal. So I see it going down, so I must have paid some long-term debt. The principal, $40,000. These are coincidental numbers by chance. So at this point I've done this, and I've accounted for this. And the only other thing that I need to account for is that my common stock account went up. Remember that we can only put par value into the common stock account. So it's not like market value changed. Market value might have changed, but it wouldn't have changed the dollar amount in my common stock account. So if I see my common stock account go up, I assume I issued more. And if I see it go down, I'm going to assume I've had a treasury stock transaction. So in this case, it increased. So I must have issued some of my stock. And it appears I issued $25,000. And at that point, I've accounted for this as well. And now I've accounted for anything, right, that could affect my financing activities by looking at long-term liabilities and my shareholder equity. I've gone down the checklist, and I think this is it. So in this case, I happen to, again, have more money going out than in. So I didn't put up a heading, did I? We should put up cash flows from financing activities. Shame on me. And then I've got net cash outflows from financing activities. Right? Looks like $55,000 out. So now I'm going to calculate my cash flow for the year. I have three activities: operating, investing, and financing. Remember, the only way you are on the statement of cash flows is if money went in or money went out. So all these things are money in or money out. So I get to the end here, and I want my cash flow. So I have this in and this out. It looks like I've got more in than out, so I have net cash inflow. Right, so net cash inflow this year. If I take the 179 from operating, subtract out the 120, subtract out the 55, I've got $4,000 inflow. And you might not think that's a lot of money. It's really not. So when people on the financial statements, because they see the balance sheet first, see cash went up last year from 33 to 37, A, this is our check figure. right? When I determine that my cash flow is 4,000, I better come back over here and double check that that truly is my cash flow. And it is, so that makes me happy, okay? I can prove that this is my cash flow. But when I look at what I've done, remember, operating activities are the things I do for my day-to-day operations. And investing and financing are different things. So for my day-to-day operations, I had inflow of 179,000. Then it appears that I bought some more equipment, and I bought some long-term investments. Then I paid some dividends to my owners, and I paid some long-term debt out. So even though I see money going out here and here, there's money out for the right reasons, right? If I'm buying new equipment, maybe I'm expanding my business and I paid off some of my debt. This is all good things. I took on a few new owners. It's all good. So when I see 4,000, I'm not totally impressed, but I am impressed, A, that it's positive, and that B, we had a huge sum of money coming in from our day-to-day operations. When I see a company and I look at their statement of cash flows and I see that they have a positive cash flow, but that their cash flow from operating activities is negative, and it's being sustained by investing and financing activities, either selling off the assets they have, right, or increasing debt or increasing issuance of shareholders, you should worry about that company. Because, right now they've got a positive cash flow, but they're not making it from their day-to-day activities. And that's not saying that you have to have a positive cash flow every year from day-to-day activities. I venture to say we're going to have a lot of businesses, right, during this crisis, that are going to have negative cash flows from operating activities when normally they've had positive because they had to close. They're not essential. They can't be doing business right now, yet they're still having to pay bills like their rent and their utilities. So there's a good chance that from their day-to-day operations, this company this year might have a negative cash flow from operating activities. But if you see it over and over and over again, steer away from this company. Don't loan this company money. Right? Don't invest in this company because they're about to run out of money. So we prepare the balance sheet, we show them the assets, but because cash is the one asset that determines whether we stay in business or not, right, that our collectors, our creditors can close us down. The people such as that are looking at these statements outside, right, we make these statements for people outside of the company, creditors, potential creditors, investors, and potential investors, they want to know where your cash comes from because it's this one asset that has the opportunity to sink us. So, I have indicated that we have a positive cash flow of 4,000, which matches this, and then we finish this out. And so we say, add cash on January 1st, which was 33,000. And then the cash that we started with, plus the cash that we had incoming this year, proves out my cash on December 31st, which is what we've been trying to prove this whole time. How did we get from 33 to 37? Well, from my day-to-day activities, I had 170 coming in. From me buying some assets and expanding, I had some money going out, and then I paid off some debt and paid some dividends. So I still had positive cash flow of 4, increasing my beginning from 33 up to 37. So this is the last statement. We always said in chapter 1, we covered the first 3 statements. Income statement, statement of retained earnings, and balance sheet. We always said we'd come back to statement of cash flows. Well, we have finished up this semester with the statement of cash flows. I will say that we will likely see it in 202 in financial because a lot of us don't always get it in 201. So, I'm excited we're done, but I have one last thing. I told you it was the last problem I lied. There's a little last problem right underneath it, number 6. And remember, I told you that all cash flows and outflows go on the statement of cash flows. But if it doesn't involve cash, it doesn't. So what happens if I buy some equipment or issue some debt, long-term debt, both things that I would call financing and investing activities, but not for cash? For instance, I walk in and I need a new piece of equipment for $90,000. I sign a note and I walk away with it. Do you agree I got a piece of machinery and I signed long-term debt? Both sound like they're investing and financing, but to be on the statement of cash flows, cash actually has to change hands, and no cash changed hands. So that machine wouldn't be on this. Only when I made my first payment on it would it ever show up, right? Cash in or cash out. So some people say, well, you should show us all those major things that sound like they're financing and investing that didn't involve cash. And GAAP tells us that there's two ways we could do that. We can make a schedule and put it in the footnotes, right, in the other notes. Or we could put an addendum to this statement of cash flows. But it's not on my statement of cash flows. It's right underneath the statement of cash flows. And I can just list the things that I did that didn't involve cash. And so if you look at number 6, it's already done for you. I would read through that. And that will finish out our semester. How exciting is that? It has been an amazing semester for those of you that are going on to graduate, or if you transfer, I'm excited for you. I have an office at Stanislaus. You can always come see me in DBH 238. And if you are graduating with this class and going on, I teach managerial over there. So maybe I'll see you there. For the rest of you, I will hopefully see you in managerial in summer or fall. But remember our book? It's not true. We decided to extend this book one more year. I told you before this book was going to get used up and you'd have to buy another one, but you are lucky now. So keep your book. Make sure you keep that code because all of us in 202 use Mind Counting Lab. And start studying for the final. I'll see you then. Okay. Bye-bye.